it's not about my tone or not or anything like that. I think I was very clear saying that, look, I'm going to take this on to see if we are well suited to be in this space. I kept saying, okay, we're going to take on this order. We had problems like we've had in the past, and we cleaned up those problems, and we came back into it. We said, okay, is this company well set up to go and execute these play orders or not? We're very well placed in the welding space, blah, 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 all of that. Okay, fine. So are we well placed in this sector? And I think what I'm learning over time is that there are many challenges in terms of how we run it versus the conventional welding business. And there are slight differences that are there. And right now, my focus is just, our team's focus is just on execute this correctly. And then we'll see strategically, is this the right fit or not?
Right. And my last question is on the exports front. What kind of growth on a very small base in exports do you see over this year and next year?
So the base has gone up. So, we were 2 years ago, we were 32 crores, and the base has gone up to 120 crores. So what is you obviously do have a base improvement effect. Having said that, there's a lot more potential out there. There's a lot of good story of the India front and many other things that give you a push. I'd like to be able to push. I don't think it's realistic to expect them to do 100% year on year throughout, but I definitely think that, in the region of 35-40% is something that we can definitely push.
Right. And if I just take out the exports growth that we have had this year, then it is on the domestic side, it makes the picture even more worse off, as in it'll be like low single digit growth for our domestic business on
value basis. Yeah, on a value basis, yeah. On a value basis, correct.
And on the volume basis, how much?
The volume basis, you're somewhere in the region of approximately, I would say 7-8% or something like that. About 7% on the consumables front, but on the equipment front, we've done okay on the domestic front.
Yes.
On the equipment front. Yeah.
Thank you so much and best of luck.
Sure. Thanks.
Our next speaker for the day is Mr. Santosh. Mr. Santosh, you are now being placed in the meeting.
Thank you for the opportunity, sir. I missed the initial commentary, so I might ask some based on the questions. What I understand is that can you please help me understand what has been the overall industry growth of the welding consumables industry in FY24, and what would be the mix from the end user point of view, something on the lines which we had shared in the June 21 presentation that we had shared. If you could just give some color on that front.
Yeah, sure. So I think we expected the volume growth in the market to be anywhere in the region of 8 to 10%. I think we are somewhere in that band at the moment, is what we saw last year. That's our assessment of it. We break that band into many different industries that you operate in, and depending on, like you said, where you're heavier, that can move. For us, general engineering, heavy engineering, pressure vessels, that kind of stuff has still been a big growth driver. We expect shipbuilding to be a great growth driver coming into this year because a lot of stuff is starting to traction on that. Railways was good, especially during the first 6 to 9 months of the year, and we expect that to continue to be good going into this year. Oil and gas has started picking up a little bit also. We've seen a lot of investments go into cement infrastructure, increases, stuff like that, where we also expect it to be very good. I hope that helps. I don't think I can give you much more detailed clarity than that. That helps in some way.
This is helpful, sir. Just a follow-up to this. If one way to understand, my understanding is that after us, the third largest, fourth largest, like that, the top 7 players after the top 2, I think have a very small market share, and they're very industry specific, and their growth has been coming from very limited number of industries. They're more focused, right? So I just want to understand what are the industries where the number 3 to number 7 player has grown and has impacted anyways our market share, and what are those industries, please? Also, what industries we have gained market share, where we have seen some competitive intensity increasing?
I'll say I keep going back to what I just keep calling general engineering, heavy engineering, that type of construction sort of stuff. I think we're doing kind of okay over there. I think that's doing fairly well. I think we're doing okay there. I would say we may have lost out a bit on certain we are not very strong on for example the renewable energy sector, the wind energy sector, stuff like that's fairly good. I think there's also stuff on thermal power and all, which we're getting into a little more. We're a little bit behind on that front. But otherwise, maybe the auto segment, lower price yields happening in certain places where we may not be seeing that much traction as the rest. We've done okay on the construction equipment front. I've been quite happy with construction equipment. That's doing well. So it's a bit of a mix like that. It's a bit of a mix like that.
On the same lines, any specific industries where we have made very significant inroads, sir?
Very significant inroads.
When I say in FY20, let's say FY19, pre-COVID, if one, let's say shipbuilding was contributing very small percentage on absolute number basis, that would have grown 4x, 3x, something like that has happened within our end user industry mix from 19 to as of today, sir, this year.
You would see it happening a bit over the course of this year, that you can see 2x, 3x, 4x, definitely you can end up seeing a little bit of all of that. I'm trying to think of where you could specifically see it. Well, railways is given simply the demand is at where it is, so that's a completely different game. We definitely lean on, like I keep going back to the pressure vessel market and general infra market, more on that also, yeah, for sure.
And lastly, sir, if one has to look at the overall industry geographically, like east, west, north, south, if my understanding is right, west and central or west would be the larger geographies. What would be the industry mix and how are we mapped to the industry? If you could give some color on that front.
So we are well placed. So we basically end up having west first, west, central, north, south, east is basically the way in which we are, our sales hierarchy goes. In west,
consumables, what would be the mix, sir? If you could give
like I just explained, it will be like that only. West will be strong, then we'll come into the central part, then you go to the south, north, and then the east.
Okay.
Yeah.
Thank
okay?
You. Yes, sir. Thank you.
Thank you.
Our next speaker for the day is Mr. Saket. Mr. Saket, you are now being placed in the meeting.
Hi, am I audible?
Go ahead.
Yeah, thanks for the opportunity. So one of my question was that, when you consider the welding consumable market and the size and the growth of it, do you also include, say, the consumable that goes into all those welding robots?
Yeah, the consumable that is used in the welding robot, yes, very much so.
So my question was, is it like, because you just mentioned that maybe on the automation side, we might be slightly behind the curve. Now in sectors like auto, where there's a bigger trend of welding automation through robots rather than standalone welding machines like yours or ESABs. So is that market growing slightly at a rapid rate? That's why that's not getting reflected in our numbers. Is that a safe assumption?
It doesn't affect the consumable. The consumable doesn't get very affected by it, and we are doing okay on that front. Where we do lose out is on the automation, totality of the solution part of it, but not on the consumables so much. No.
Okay, so when you mention say 13% automation, is it like 13% of your consumables go towards automated machines?
No, it's the solution, the welding equipment part, the solution part that is part of the welding.
Okay, and if we say have the same breakup for consumables, how much goes into automated and how much goes into, say, the welding person operated standalone machine, how would that mix be?
So it's almost in India still, I would say, my estimation, 90 to 93, 94% will still happen through the 90% will still happen through a very conventional mix. 8-10%.
Okay. And does that tally with the say the overall India landscape and automated versus say
Fairly in line.
standard?
Fairly in line. Fairly in line.
Okay, okay. Now, I know I joined couple of minutes late. Is there any update on the Fontech amalgamation? If you can kindly repeat that.
It was listed at, the last NCLT meeting, we were hoping it would go through, we were very close to it. It's now listed, expected to be, on the 7th of May, listed high, and we hope the NCLT is in a position to pass it through.
Okay, thanks for the update. Now, my next question would be that there is some bit of I think the price, especially of these metals like copper, aluminum, are on the rise. So, do you see that impacting our margins for in the consumer space or anything on that front? If you can guide us.
I don't see it having any negative impact. I think we should be smart about how we handle it. And we've gone through a fair amount of learning curve on this. Now we just need to be smart and implement what we've put in place. I don't think it's going to be a negative. No, not at the moment.
Okay, thanks. And any view on the channel, say inventory right now, is it manageable or on the higher side or?
No, I think if you ask me personally, I was telling everyone earlier because steel prices have been going down over the last 3-4 months. Only now has been moving back up. I feel the channel inventory is slightly low in fact.
Okay. Yeah, thanks. I really appreciate it.
Thanks.
Our next speaker for the day is Mr. Vandit Dharamshi. Mr. Vandit, you are now being placed in the meeting.
Hi, thank you for the opportunity. I just have some bookkeeping questions. If you can just give absolute volume number and metric tons, say for consumables and then exports. And
I'm sorry, Vandit, I can't give you absolute numbers. We don't do it. And to be honest with you, my competitors only give segment results. So I personally I don't do it. I'm sorry, I can't give you absolute numbers. That's right.
Okay.
I can give you a rough estimate of something if you want. I can always give you a rough.
Yeah. Even rough estimate will work.
All right. So what do you want?
What would be the volume mix, maybe in terms of percentage, when it comes to exports and domestic consumables?
Volume mix of export and domestic will be at least, I presume, 85%, 80 to 85% will be domestic.
Okay. And maybe number of units in equipment's business that we would have sold, say year on year. If you can give percentage growth or absolute number, whatever works.
We've grown by about 25-30% this year on the equipment numbers. I don't want to give you those numbers because that's a little sensitive, especially because all of my competitors import their data, import most of their stuff. But it's about 25-30%. We've seen 30% plus. We've seen volume growth.
Okay. Thank you so much.
Thanks. Sorry, I hope you understand. I'm very little careful on that. Thank you.
Our next speaker for the day is Ms. Harini Dheria. Ms. Harini, you are now being placed in the meeting.
Hi, Aditya.
Hi.
Question on the consumables front on the domestic side. You said you're working on a few things to see if we can possibly eke out a little more growth than the market this time around in FY25. Would that be more product offering led, or that is something that
product offering led? We just implemented 1 or 2 new lines, so it'll be product offering led. Very correct.
Okay, and our mix versus our competitors, are we 85-90% there in the same basket now, or?
The product mix front, you're very close to being there. I would say 85%, at least 85-90%. It's a little more. Look, I don't want to comment on that. I don't comment on anyone else's business, but I can just tell you that, look, there's an element of, like I keep saying, knowledge process outsourcing on the non-product front, where we don't play a role. And on the second front, there is obviously the MNC ability to source exotic materials in a different perspective than I do. And so be it. But that doesn't mean that we don't have the offering. We have 85% of the offering. It's a question of implementing that offering correctly that we need to learn.
Got it. The second point is on consumables margins. At least domestically, when we ask around, the listed prices seem to be very similar versus your competitors now. So trying to understand why they report sort of better on gross margins than us. So is it because it's not pricing led anymore, right? We're pretty much.
Maybe a slight bit, maybe 2-3%, 1-2% could be pricing led. You're right, it's not a massive difference. But I think product mix is the basket, in their basket of sale, the amount of exotic that is there is still a higher richer mix than it is in mine. So that's where you're going to keep seeing that. We have to keep pushing that.
Okay, got it.
That
Thank
doesn't mean we don't have the offering. We built up the offering, we're building it up more and more, but that doesn't mean we're selling the offering adequately. So we have to keep pushing that also. So both ways it works.
Okay, got it. Thank you.
So thanks.
Our next speaker for the day is Mr. Devansh. Mr. Devansh, you are now being placed in the meeting.
Yeah, so thanks for the opportunity. Sir, any commentary if you can share on competition from imports? Do you see that going higher this year or any?
I don't comment too much on competitors. I don't think I'm in the right position to do so. So I'd rather refrain from that.
Okay. And so any outlook you can share for Ador Fontech? Where do you see the business for next 2-3 years?
I think, look, the business is now, as we consolidate and as we get into the merger front, hopefully that'll get kicked off quite soon. What ends up happening is you have Ador Fontech's, basically we have M&R, maintenance and repair products, you have maintenance and repair services, and then you have the capital range. The capital range gets combined very quickly with the Ador Welding range. That all goes into one basket of the welding equipment and cutting front. Then what you're left with is the M&R products and services. The M&R products have been in place for a long time. You keep pushing a few competitors, you got to push it through the distribution network, and you're looking at anywhere in the region of, you can hit, depending on how IIP is looking, you can hit between 8, 10, 12% growth on that. Doing kind of well, and you see a good value mix on that going forward. On the services front, where you can take on more and more jobs with more and more benefits, larger solutions, there is potential to grow that exponentially if executed correctly. But again, you have to execute correctly. So that's where we aim to push over the next 2-3 years. And
in terms of any internal targets we have, in terms of what is the kind of sales profile we are looking at for Fontech for next 2-3 years?
I think it's like I said, I don't want to give an exact number, but it's pretty much like, I don't give a forecast, but it's pretty much in line with what we were saying on the IIP front in terms of what their top line is today. Should be, at the lower level.
And any reason why, so like the business has been kind of consolidating for last 3 years, like in terms of, and actually for an even longer time. So where do you see the change will come that can change the trajectory for sales growth profile?
For the M&R services, on the M&R services is going to be the big. You have to do that correctly.
Okay. Thank you.
The capital equipment front, once it gels into the welding thing, will automatically see a slight pickup as well. It's been a little subdued because we've been focusing a lot more in the last year or two on the M&R front, especially on the products front, rather than the capital equipment, because we knew the merger was happening. So that's how we sort of played it out a little bit for that front.
Okay. Thanks a lot, sir. We wish you all the best.
Thank you.
Our next speaker for the day is Mr. Rahul Jain. Mr. Jain, you are now being placed in the meeting.
Hello, am I audible?
Yeah.
Sure. Sir, my first question is with regards to the equipment side. So typically, say, not just about the next year, but overall in next 2-3 years, what kind of margins do we feel our equipment business can do on a longer term basis?
Like I told someone earlier, I think we should be in a position to at least increase it by 60-70% compared to where it is today at least. We have to just do a few basics correctly and a few things we have to turn around and we should be, and remove some fat from the process, and I think we should be able to do it easily.
Mm-hmm. And sir, with regards to the flare business, you mentioned there are cost overruns in that project, which could probably lower our margins. So typically, those margins will be somewhere, say, in the region of mid-single digit, or what kind of, maybe not the exact number, but what kind of range it could be in next year?
Yeah, like I indicated earlier, we were always looking at 9-10% type of level. I think we got to take that down a little bit, so somewhere there. But then we got to take it down a little bit.
Sure. And sir, with regards to domestic business on the consumable side, can we expect a double-digit growth going ahead, or what would, what can drive that double-digit growth?
I would tend to believe so. There's no reason. I mean, you presume elections apart and everything else apart, just a regular movement of the economy the way it is. I would assume so that we'll be in a position to do that, yes.
Sorry, I missed the last 2-3
Yeah,
words.
I said, I assume so. There's no reason we should not be in a position to do that. Yes.
Sure. Thank you, sir. Thank you.
Thank you.
Our next speaker for the day is Mr. Ram Prasad. Mr. Ram Prasad, you are now being placed in the meeting.
Hello, am I audible?
Go ahead.
Yeah, thanks for taking my question. My question is regarding your subsidiary 3D printing technologies. It has been making continuous losses. So, what is the outlook for that subsidiary?
So as we it's actually a subsidiary of Ador Contact, but since we're on the subject, it's okay, we can discuss it right now. The market around, basically the subsidiary works on the dental market. It services the dental market with clear aligners. And the market around us has changed a bit, and there's been a lot of funding that's happened to larger organizations that have been burning a lot through it. So we've been sort of very clear that we want to stick to our core philosophy, keep driving at it, and while doing it, keeping our burn completely in control. So we managed to reduce our losses quite significantly year on year. We managed to reduce our burn quite significantly year on year, and just work on the core philosophy of what we want. I think in the next 6-8 months, we'll see that industry also go through some changes, and then we'll take a call on which way it should move. But I think it's very simply like I keep saying, you know, what is the core business, and then what are the other ancillaries, and then we've got to figure out how to house those correctly.
But does it have any synergy to our core operations of welding?
It does not have any synergy to the core operations at the moment. It does not have any synergy. Let's be clear about that. That's the reality. So we have to figure out how to do something where we've created some value correctly. We'll get there. But right now it's a very small subset of the entire thing. But you're right, it has to be figured out correctly.
Okay. Then my next question is on how are the imports for the consumables in the welding consumables, please? Can you throw some light?
No. In the welding consumer space, nothing major. So when you see the imports now becoming more and more prominent is as you move more into the exotic metals, and you move more into doing more higher end type of steel work, then automatically the imports come again. Those become more Europe related, Western market related kind of imports, which again we are trying to work on how we have better products or we have a better offering over there. So that's where it is. I'm not too concerned about the mid or down segment part of imports, not at the moment.
Is it not eating into our quantities? I just wanted to know the imports from China and all basically.
No, I don't think that's it. No, I don't think that's it. I think
okay, thank you very much.
Just correct a few things and get it. No, I don't think I'm not stressed about that part.
Okay, thank you very much.
Thanks.
We have a follow-up question from Mr. Ankit Gupta. Mr. Gupta, you are now being placed in the meeting.
Sure. Thanks for the opportunity again. My question was on, I had two questions basically. One was on the, dividend payout front. So last year we saw, 40% kind of dividend payout. And a year before that also, we had given the same, the dividend payout was around the same percentage. So, with the capex that you are planning to do for next year also, so the dividend payout will remain the same, or do you think there is a scope of improving the dividend payout to, let's say, 60 or even higher percentage?
I think the idea is that we keep the payout ratio where it is today for the last 2-3 years as a sort of benchmark, and as soon as the opportunity arises correctly to be able to go above that benchmark. I just don't want to commit to it at the moment.
Sure. And on the consumable front, you did highlight about the challenges that we faced in the second half of last year. But I was just going through our, Q2 or H1 Concall transcript, where we had said that our volume growth in the consumable front in H1 was around, 22%. So it seems that, second half has been pretty challenging for us. So is that true?
Keep in mind, like I was discussing that period also, the Q1 of the previous year, the base effect had gone for a toss because of that Russia war and all that thing that happened. So your base effect growth that happened over HY1 last year was very high compared to the previous year. And that sort of streamlined a bit. But yes, you're right, in Q3, Q4, it's been a little more subdued than you would have seen in HY1 on that front. Yes.
Okay, so given the kind of base that we have for next year, like, do you think, the kind of growth we are targeting at least in double digits will be possible?
Yes, and I stand by the fact that I think it is possible, and we'll see how it goes. I stand by the fact that it's definitely possible.
Sure. Thank you, and wish you all the best.
Our next speaker for the day is Mr. Kiran D. Mr. Kiran, you are now being placed in the meeting.
Thank you. Just one question, sir. I need a slightly broader commentary rather than any specific numbers. So we have seen across capital goods, and I'm not just referring to your competition, but generally broader capital goods where every player has reported great numbers. Every player is talking of growth, capex, and so on and so forth. So if you could help me understand, and I've been part of shareholder of the company for about 5 years, you can help me understand at what part of the cycle will we be able to see growth? Because we had the low part of the capex and all the maintenance. I'm including Fontech as well as welding. So the maintenance part of the business, the operations part of the business, the consumer part of the business. So we had the low part of the capex for about 7-8 years, and then we have had the last 1 to 2 years, or at least 18 months, where there's been tremendous growth in almost all capital goods. So if you could just tell me where does Ador Welding especially fit in, because we were neither part of the growth previously when the capex was down. Now we are not part of the growth in the last 18 months. So where do we fit in? How does our growth kind of...
I'm going to have to defer with you a little bit over here. If you've been a shareholder for the last 5 years,
Sure.
you tell me that you've not seen growth is something I find a little odd. I'm talking about Q4 mainly, where there was a 1% sort of growth only. I never talked about the last 18 months of the capex cycle. Let me be clear. And if you've seen my results, you'll see that there's not the same in line with what you're saying. Our volume growth and our top line growth has been very much in line or outperforming the market before that. I'm talking about the last 3-4 months. So let's not mistake my commentary for Ador Welding's inability to catch on to the capex cycle. I'm talking about the last 3-4 months. And I don't know if you have seen the last 3-4 months data on the welding industry front or not from any other competitor, but you will not see anything very differently to this in the last 3-4 months.
No, so why is that, sir? That's the reason that I wanted.
So let's be first, please be a little clear on that, right? Let's be a little clear on the timelines we're talking about, right? Our numbers in terms of volumes altogether have pretty much doubled in the last 3 years. So there's a huge difference on that front, what you're saying and what I'm saying. So let's be clear on that. Now you're talking about the last 3 or 4 months. I'm saying the last 3 or 4 months. We have had a fairly subdued thing, because I feel the industry has also been a little subdued on the welding perspective due to product mixes and due to industry picking up. The railways in the last 3 months has not been exuberant. The railways in the last 12 months is exuberant. There is a slight difference that is happening over there. So we need to understand that. Is it going to be exuberant going forward? It should be. Whatever we can see on the spending front, it should be fairly good on that front. So you have to understand the timelines we're talking about, the scenarios we're talking about. The welding industry per se, on our equipment front, we're seeing good numbers. We're seeing all of that take off as well. So we have to be clear on that perspective.
Fine, sir. Okay, cool. Thanks.
We have another follow-up question from Mr. Santosh. Mr. Santosh, you are now being placed in the meeting.
So thank you for the opportunity again. I just wanted to understand what would be the approximate revenue mix of the consumables, FY24 consumable revenues between stick electrodes, solid wires, flux coursed wires, and soft flux.
So normally, basically, what you do is you take stick electrodes as one segment, and you take all the other wires and fluxes as another segment.
Okay.
Stick electrodes would probably be approximately 60, 65. You're saying 58, 42. 58, 42 is what you're looking at from that.
Okay. Okay. Sir, also one more from a business point of view, I think. Is it fair to assume that the projects-based business tends to have lesser gross margins than the dealers and distributor-based business? Can you please help me understand the difference?
Slightly lower depending on the product mix, slightly lower, yes. And also the fact that you're extending a larger payment term credit cycle also. So yeah, slightly low.
If I have to understand the differential in margin differential at the gross margin level, is it fair to say 100 to 150 pips kind of difference could be seen in these two models of doing business? And on the collection cycle, what would be the collection cycle for these two?
Average collection cycle will be somewhere in the region of 60 to 70.